Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. It's just after 12 noon Eastern Time. Of course, I also want to say good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones. And of course, good evening to those of you who maybe are joining us from across the pond in parts of UK or parts of Europe. Well, welcome to today's presentation, a radioactive trading presentation where we're going to talk about the 3 core principles of investing and, of course, a new trade comparison looking at limited risk positions. Some ideas that are out there about how to best approach a trade with limiting your risk, controlling your risk, and still taking advantage of upside profit potential or potentially downside profit potential as well. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options and at RadioActiveTrading.com. All right, so let's go ahead and jump in. The first thing, why are you here today? Well, you're likely here because you want to get insight into properly limiting your risk on your investing. Limiting our risk is really the only thing we can control in any option strategy. Any option strategy we trade, we know that we can maybe have a maximum profit if things work out the way we want. Things such as a credit spread, an iron condor, even a covered call or cash secured naked put. You can try to control risk with a stop order. However, all of us here probably know that stop orders can get violated very quickly and you can end up with a larger loss than you originally anticipated. You may be here because you want some new ideas on trading, see if this can work out for you, or you're here because you're already practicing one form of a little limited risk strategy and you want to see how things stack up today. So what we're going to share today is we're going to show you some of the trade comparisons on these ideas of different approaches for limited risk trading. In the past few weeks, maybe even 2 months or so, I've had questions during these webinars come out about the comparisons. Now here at Radioactive Trading, we do use a married put setup. The concept of a married put is nothing new, but we approach every new position with a unique structure of a married put setup. Well, there are other strategies that are being taught out there as a way to limit risk and get benefit of different market movements. One is referred to as the reverse collar. We're paying a very small amount for a put option and trying to receive a very high amount for selling a call option on the position so that you reduce your cost basis up front and you have a low risk. And then there's another idea out there which is talked about the poor man's married put. In a married put or radioactive trade, I am going to buy stock and I'm going to buy a far out in time, slightly in the money put option to properly control my risk. Well, the idea is why buy the stock in the first place? Why not buy an in-the-money call option that's far out in time with a high delta and buy the put as well so that you have a lower cost into the position using leverage and you can still take advantage of close to a 1 delta. Okay, so those are some of the ideas. Now, very basic view, and I decided to do this through drawing as opposed to through a screenshot. In a married put position, we're going to control our risk by buying stock and leave the upside open. And we're also going to buy a put. So if the stock falls, we can exercise the put option. We have a control risk into single-digit percentages. Now the in-the-money long strangle, rather than pay the money to buy the stock and protect it with a put, adding more cost to the position, we're going to use leverage to buy an in-the-money call and at the same time buy an in-the-money put. So we end up with what's called a strangle, which can profit to the upside and the downside in case of wild swings. And the idea is to use leverage to have a lower cost basis. The reverse collar is its own little animal. It's an idea of taking a standard collar where I'd buy stock, sell, an at-the-money call 1 month out, and buy an out-of-the-money put to get a profit and loss chart that looks like a bull put credit spread, maybe a bull call debit spread. But what the reverse collar does is an investor will buy the stock and buy an at-the-money, typically, 1 or 2 month output, and sell a 4, 5, or 6 month out call that's out of the money for a credit. And in the first expiration series, we see this strange little check mark profit and loss chart, where your losses, if the stock stays at the same price, you may be able to profit a little bit on the downside if the stock falls, and of course, have some upside. But the upside's capped because of the short call without management, unlike the other two strategies. There's a potential to profit to the downside, perhaps, based on the structure of your trade. But again, that's only in case of a wild swing. So which output is better? Which profit and loss chart is better long term? And which one best suits your trading goals? Well, I'm going to try to answer that today looking at the comparisons. Before we jump into the strategies themselves, the first thing we need to talk about are the core principles of any option strategy. Now we can delve into the components of these different concepts. We're not going to today. I'll explain that in a moment. But really the three core principles approaching any strategy. I don't mind if you're trading covered calls, if you're trading credit spreads, if you're speculating by buying calls and puts or maybe doing straddles around earnings. The three core principles of a successful options trader are proper position sizing, making sure that you're not risking too much on any one position or too much of your portfolio in any one trade. What's known as the at-the-money bell curve, making sure that we take advantage of how the options are laid out when you look at any chain for a given stock. And also, of course, the factor of time decay. We want to make sure time is on our side. Now, real quick, I'm just going to ask, real quick poll, excuse me. What I want to know is, what types of options strategies are you trading now? Are you mainly looking at selling covered calls, maybe hoping to get assigned or maybe long-term on dividend stocks selling out of the money calls or cash-secured naked puts? Are you trading spread trades right now? Bear call credit, bull put credit, debit spreads? Are you looking at buying options? Do you buy calls and puts a lot, speculating on a market movement using leverage, or then maybe leg into straddles and strangles as the stock fluctuates in price? Or are you currently doing diagonal spreads, horizontal or diagonal spreads? And of course, I know some of you are doing others. You might be doing the reverse collar. You might be doing the in-the-money strangles, which would fall into the option buying category as well. And you may be trading radioactive positions at this time as well. All right, so I've had the poll open for a minute. A fair amount of you had voted. I'm kind of surprised here that there is a 0 located in our 5 answers. I didn't expect, I expected answers, I'm sorry, in all of these. But let me go ahead and close the poll, and I'll share the results with everyone. Okay, and this is going to be beneficial for me too as we go forward, but also beneficial for you as we talk about the 3 core principles and what's solved. Now, 12% of you are doing covered calls and cash-secured naked puts. Most of you, the high percentage, are doing the spread trades, leverage spread trades, high probability of expiring worthless, or maybe you're doing slightly out of the money spreads, but most of you are probably doing in the money or out of the money spreads, the high probability. No one lists option buying as their main approach. And 18% of you are doing calendar spreads, what might be referred to as the poor man's covered call, for example. And 24% of you are practicing some of these other strategies, whether you're following an advisory service or, again, you're trading one of the other strategies that I mentioned going forward. Oops, there we go, sorry about that. All right, let's go ahead and hide that real quick. Now, when we approach a radioactive trade, we open a new position by buying the stock, buying the in-the-money put, following the rules outlined in the blueprint. The first thing we're going to do is force an ideal size trade. Because I'm buying the stock and buying the put, I can't over-invest. right? I'm not going to be able to buy 2,000 shares perhaps of a $60 stock because I might not have that much available in my account. Okay, and we're going to control our risk on the position not only to single digits, but we're going to make sure the monetary risk of the married put, the absolute worst case scenario, doesn't represent more than 2% of our total portfolio. This saves us from ourselves and over trading by the proper structure, and we're forced into proper position sizing. The at-the-money bell curve principle. You look at any stock, of course, on any option chain, the ones that are right at the money are going to have the highest time value, okay? And at the same time, those that are out of the money or in the money are going to have the lowest. It's known as the at-the-money bell curve. So what does this teach us? Well, this teaches us to maximize our time value profit or minimize the time value risk if we're buying. We want to be selling options that are close to at the money. And of course, we want to be buying options that are in or out of the money to lower the time value cost, which would be the risk. If I just bought a call and it had a high time value, well, if the stock doesn't move, we know that's going to go to zero. So that's my true risk on the position. And of course, the time decay line. As we watch options, whether we're selling, whether we're buying, those of you doing spread trades and covered calls, you're probably taking advantage of weekly options because you want that rapid time decay over that 4 or 5 or 6 day period. And you know that selling 3 months out in time, you're going to have to wait almost 2 months to start seeing some reasonable time decay in your favor. So you want to be selling shorter term, but you also want to be buying farther out in time because those options tend to decay more slowly, even though you paid into a higher time value. Okay? So, proper position sizing, even with limited risk strategies, especially the leverage strategies where you know the risk up front. Those of you doing credit spreads, I might enter a bull put spread. I've got a 5-point spread and I receive a 50-cent net credit. I know up front that the most I can lose on that position is $4.50. But what I also know is that I'm taking a 9-to-1 risk-reward ratio. I'm risking $4.50 to try to make 50 cents. One trade goes against me, that can wipe out 10 or more previous successful trades. You have to be right close to 90% of the time when looking at a probability of 80% or higher. That's where we usually do it. You know the risk up front and how much you can lose. And if I take that spread with only a $4.50 risk and I'm in a, let's say, $100,000 total trading account, I probably only want to do maybe 3 or 4 contracts to make sure I'm not risking more than 2% of my total portfolio value. Now, because you buy the stock, this concept of the radioactive trade, the married put in general, and even the reverse collar is going to force you into a deal-sized trade because you can't overtrade, as you can do in spread trades, as you can do with calendar spreads as well, because you're using leverage to get a lower cost. But if you buy 10 contracts of a calendar spread because you had the $5,000 to put into it, and the stock moves against you quickly, let's say in a diagonal call spread, a 10% drop in the stock could be a 50% loss of what you invested because of the lie of leverage. Okay? So that's the idea of proper position sizing. Now, we're going to talk about our 2 comparisons, this reverse collar and this in-the-money long strangle, as a better way to control risk, is how it's brought to my attention. But first, I want to talk about the old school main comparison to what we do here at RadioActive Trading. Okay, this is going to be an older example, but the principles are still the same. The big detraction to looking at a married put, and this is why some of you come across the idea of the in-the-money strangle, because you want to control the stock with a lower price, but you still want to have the protection. But when you look at the profit and loss chart of a married put, the first thing as an options trader you're probably going to say is, well, the married put is the same as buying a call option. If you're buying an in-the-money put to protect your stock 4 or 5 months out, that's the same as buying an out-of-the-money call that's 4 or 5 months out, but the out-of-the-money long call is better. How can something be the same but better? It doesn't really work. Here's how I would structure a radioactive trade. Now ignore the date. We can take any stock that's trading at any price right now, and this is what I would do. But let's look at PXP, this older example from the old trade comparison presentation. I could buy a stock today, let's say trading at about $35.08 per share. Now at the same time, I might buy a January, if this was June of 2011, but I might go 6 months out, 7 months out. So in June of 2011, I might have bought a January 2012 40 put for $7.25. Now, the married put will cause me to increase the cost basis. Now I have a cost of $42.33. But because I bought an in-the-money put, I'm guaranteed to get $40 back. So my true risk is just the time value, or $2.33 of what I invested, which comes out to 5.5%. And if I'm trading in, let's say, a $40,000 account, I would buy 200 shares and 2 puts, so my maximum risk would only be about $466, or about 1.5% of my total portfolio value. So I'd be risking 5.5% in the trade, but make sure this monetary risk doesn't represent more than 2% of my total portfolio value. I'm forcing an ideal size trade. Now you look at the profit and loss chart of a married put, and you'd say, well, that's the same thing as if I had just bought a January 40 call for $2.30. The maximum profit is infinite. It is not capped by buying the call, and your maximum risk is only $2.30. So you lowered the risk. My married put had a risk of $2.33 off an investment of $4,233. You just paid $230 for a contract, so you've got a 3 cent or $3 less risk. This must be a superior trade. Standard profit and loss chart at the time of open of the PXP trade back in 2011 would look like this. The blue line down here at the bottom represents the worst case scenario. If I'd paid $35.08 for the stock and paid $7.25 for the put for a total outlay of $4,233, is my break-even $42.33? Yes. If I held the position all the way to January expiration from June, and I made no adjustments on the trade, I would need the stock to be trading at $42.33. But because I bought the put far out in time, to solve the 3 core principles and match those to satisfy the 3 core principles, this option does not decay. And at the halfway point, I might only need the stock to be trading right at around $39 or $39.50 to be at break even, because the put doesn't go to zero. The minute I open the position and paid $7.25 for the put, I could turn around and sell it for $7.20. All I'm risking is the bid-ask spread. Now sure, the option's going to decay, but it's not going to decay rapidly because it's a proper structure. All right, but back to just the long call, our sort of bonus comparison. What's the profit and loss chart of a long call? Well, it looks the same. If I had bought that January 40 call for $2.30, the max risk, the worst case scenario is I could lose $2.30. Is my break even $42.30? Yeah, only at January expiration if I make no adjustments, don't roll the position, or do anything on the long call. And again, at the halfway point, we could be at a profit if the stock was just trading at $39.50, because it's not going to decay rapidly against us. It's not going to go to zero as soon as we buy the call. So a little bit of movement in the stock could lead us to a profit well before the quote-unquote break even. That's only at expiration. But why wouldn't I just buy the call instead of doing the married put? The long call and the married put do have a similar risk-reward profile. I would never argue that. Graphically, they look the same. But the problem comes with the discipline. Anytime you use leverage to get into a trade, you run the risk of over-trading. You don't force yourself into an ideal size trade. Remember, if you paid $2.30 for the long call, you're risking 100% of what you invested in the trade. Okay, but again, the investment was only $2.30. It was 3 cents less than the risk on the married put. But as a long call trader, is that what you would do? No. Okay, so let's side-by-side comparison. On the left, we're talking about the married put. So if I had an account of $100,000, and in that account, I had $17,000 worth of free capital to trade. Well, the total cost of the married put, stock plus put combination, would be $42.33. I'm risking $233, or 5.5% of what I invest in this trade. With $17,000 of free capital, I could afford to buy 400 shares. This would put me at a cost basis of $16,932. But remember, with 400 shares and 4 puts, I'm only risking $932, which is less than 1% of my total portfolio value. Now over here on the right, same account, $100,000 total value, $17,000 of free capital. The call would cost $230. Your risk is 100% of what you invested. Well, with $17,000, you can afford to buy 73 contracts. And so if you're not disciplined, you could invest $16,790, which means you're risking 16.7% of your total portfolio value. That's the lie of leverage and the risk of overtrading. But I'm exaggerating on purpose. Okay? I know you would not buy 73 contracts of this position because you had $17,000 of free capital. But let's be honest about the nature of an investor. If you saw me open that married put, I posted it on the blog at RadioActive Trading. I sent out an email that I just opened 400 shares of this stock at $35.08 and bought 4 put contracts at $7.25. So my total cost basis was $16,000, okay? And you said, well, I'm going to do the same thing. And even if you're disciplined to buy only 4 contracts to match my 400 shares, what are you going to do with the rest of the capital that you had free in your account? Are you going to put it on hold and not trade with it? Or are you going to buy 5 calls of stock ABC, 4 puts on stock XYZ, 3 calls on SPY, and so forth, okay? That's the nature of the investor. So now that $17,000, you might invest $15,000 into different calls, puts, calendar spreads, and so forth. But remember, in those strategies, you're risking 100% of what you invested. And of course, if you're trying to diversify, well, that's a form of protection as well. But remember, when you diversify, the gains that you see in the stocks or your calls are also less because you have more of them. You have some that are gaining, some that are losing. So if you have a 10% gain on one call on your total portfolio, it might only be 1% because the other positions aren't moving. So again, the true parity trade, the true risk comparing the long call to the married put, is if I bought 400 shares and 4 puts to have that investment of $16,932, but was only risking $932, the true parity is to buy 4 calls and have a cost basis now of only $920, which is still less than 1% of your portfolio, but leaving the other $16,000 aside in your account. This is what we're talking about with forcing an ideal size trade. This is where the leverage comes into play, and many of you have probably been hurt by it over time, over-investing in a credit spread because you were positive that you had an 85% probability, but unexpected news came out and you traded 15 or 20 contracts. Okay? Diagonal spreads, maybe you entered into more contracts than you should have because you liked the position and saw a good risk reward, but the stock fell 20% and your long call is down 40 or 50%. And that's the lie of leverage. It works both ways. Second principle that applies to any option strategy is, of course, the ATM bell curve. You look at any option chain for any stock at any expiration close in or far out in time. The call options and the put options that are closest to the stock price right now, the at the money, will have the highest time value on the chain, comparing it to same expirations. Those that are in the money or out of the money have the lowest time value. So what does that really mean? Well, it means as option sellers, we want to be looking at the money to get the most amount of time value. You might be speculating on your covered calls and selling far out of the money, hoping for an intrinsic gain. But the true profit we make as option sellers, doing credit spreads, doing covered calls, the sell portion of the diagonal spread, is the time value you get in, and hopefully that decays for you to maximize the return. But when you're buying options for your diagonal spread or your horizontal, when you're buying options for your credit or debit spread, the option you're buying is in the money or out of the money, okay? Because you want to be paying less into the time value and possibly getting the most intrinsic gain as well, okay? Okay, and I'm sorry, just going back a little bit, John has a valid point, and that's true. He says, if my trading system has an edge, which it does, I'd be silly to set aside the 16K, talking about the parity trade with a long call, for the opportunity to earn less than 1% interest. Now, that's very true. Okay, I agree with you that you're not earning a lot of interest right now, putting that capital aside. What I'm showing you is to control the risk and call it a true parity trade. Buying a call is not a parity trade to the married put, is what I was getting at, John. Buying a call and setting aside the capital that you would use to enter the stock and not use it for other trades is the true parity trade to a married put. Okay? All right. So again, the at-the-money bell curve, when we're selling, we want to be selling at the money, and when we're buying, we want to be buying in or out of the money. And of course, the third principle, the time decay on our side. What is the one fact we know about options trading, no matter what strategy that you're using? Well, as you get closer to expiration, your time value goes to zero. Okay, it doesn't matter if it's in the money or out of the money. If you're in the money, you keep intrinsic, the time value goes to zero. If you're out of the money, the option goes to zero. Okay, that's the general rule we know. That's the guaranteed fact. As we get closer to expiration, time value goes to zero. But options that are farther out in time decay more slowly. As we know, those that closer in are going to decay percentage-wise more rapidly. And another advantage of this, looking at the farther out options, an option at the same strike that's 6 months out in time won't be 6 times the cost of the near month option. If I looked at, let's say, a 145 call at Apple right now for 7 days out in time, it might be priced at $1.10. And if I go 6 months out at the 145, that same call option is not going to be $6.60. It might be $4.80. It might be $5, but it's going to be less than 6 times the cost. Okay, so that out of the money option gives you a lower cost per day. But if you sell further out to get that $5 premium instead of the dollar premium you could in a 10-day out or 14-day out option, you're getting a lower annualized return by selling further out in time. But by buying for insurance or buying for speculation, you're paying a lower cost per day by buying further out in time. And this is what we see going forward, okay? And this is what you see when you're looking at options. Call or put options, no matter what, but the time value for something that's 150 days or 120 days, well, the first 30 days from 150 to 120, you're going to see a slow time decay. And then from 120 to 90, you're going to see a slow. And they start to get a little bit more, and in that last 30 to 45 days, the decay really takes off percentage-wise. So when I'm selling and I want time decay to disappear rapidly in my spreads or in my covered call, where do we want to be selling? Under 30 days. And if we're buying for speculation, buying for insurance, or buying the diagonal, right, the call or the put for your diagonal calendar spread, you want to be buying out here so the time decay of what you purchased doesn't decay rapidly in the first 20, 30 to 40 days. You want to put time on your side. So when we buy, we want to buy further out, and we sell, we want to sell closer in. All right? Now, all of this, we can go in more in depth and say, okay, well, the red line also takes into account the gamma and the theta and the ATM bell curve. That takes into account the delta and so forth. But we don't need to go that in depth. We don't, because as options investors, what do we want? We want to maximize return when we're selling. And to maximize return, we'd be selling at the money, and we'd be selling closer in time. And when we're buying, we want to have a lower cost per day, a lower annualized cost. So we want to be buying further out in time and buying in or out of the money for the lowest time value cost. right? And of course, we don't want to overtrade. We want to force proper position sizing, right? So we want a structure that gives us control and forces us into an ideal size trade. We want to sell premium at the money and buy in or out. And as far as time decay, again, buying further out and selling near term as well, okay? Santosh asked a question, how about replacing stock with futures? Would it be easier for people with lower capitals? Well, now you're getting into a whole different ballgame of margin requirements and so forth and risk into the position. Trying to protect a future with a put, of course, can be done, but it's going to change the dynamic of your trade because you cannot own the underlying. All right? It's just like a spread position. You know, I could buy a call, we'll take a look at that. I could buy a call and buy a put to create a strangle, so I'm protecting the call with the put and protecting the put with the call if it goes against one of the other positions, but it changes the dynamic of the position. All right. Now, let's get into our recent trade comparisons, comparing our reverse collar and comparing the in-the-money long strangle. On March 2nd, looking at AEIS, here's a radioactive trade, a married put I would have opened, following the rules in the blueprint. On March 2nd, 2017, I would have bought 100 shares of AEIS at around 62.42. At the same time, I would have bought an October 65 put. It's roughly 7 months out in time, it's about 230 days out in time, for $7.35. Okay? Now, that price, $3.13 of it, roughly, is intrinsic value to the 65 put. I'm sorry, back that up, $2 and about 89 cents of it or so is intrinsic value because I'm buying the 65 put, so I'm guaranteed to get that difference back. So yes, I am investing $69.77, but we're guaranteed to get 65 back. So the $7.35 we paid for the put, we're only risking the time value or $4.77. This represents 6.8% of my total portfolio value. And if I had a $40,000 account, I'd probably only open 100 shares and one put to keep this risk, $477, under 2% of my total portfolio value. Okay, and if I had 100,000, I'd probably do maybe 200 or 300 shares, probably 300 shares. So the risk was under 2% of that total portfolio value. Proper position sizing. Now again, is my break even $69.77 where the cost is? Well, yes, but that's only at October expiration. I hold the position all the way to October, accept no dividends, make no adjustments. The worst case scenario is I could lose $4.77. But you see here that curve red line at the halfway point, I might only need the stock to be trading at $65, $65.50 to be at break even. Okay, and 1 to 2 days out, if the stock moves up $1 after I enter the trade, my put's only decline 40 or 50 cents. So I still have a profit. This break even only exists at expiration, which is 7 months out in time. Okay, so has to go all the way to October to consider this break even of $69.77. Did we force an ideal size trade? Why, yes, because I had to buy the stock in order to get the proper structure. So I can't overtrade. Did we control our risk and leave the upside open? Absolutely. So with radioactive trade, are the 3 core principles satisfied? Yes. Proper position sizing. I'm buying in the money for insurance. So we're satisfying the ATM bell curve. And time decay, buying insurance, I bought 7 months out. So again, I satisfied that one as well. Okay. Ziggy says, is using stocks with a high dividend good to reduce risk? Let me go back to the profit and loss chart very quickly. So what Ziggy's asking is, let's say I entered into a married put. Now we know this one here has a risk of 477 or 6.8%. Okay, and Ziggy wants to know if I had done a similar structure of this trade or our other trades, What if I bought it on a stock that was trading at the same price, around 62.50, and I bought an October put, but this particular stock, let's say, paid an 8 or 9% dividend? Okay, well, what would happen? Well, my October 65 put would not be priced at 735, or I'd have a risk of 6.8%. The October would probably be priced closer to $9 or $10, so that I'd have an at-risk on the married put of probably closer to 9%. Now, what do we know about stocks that pay a high dividend, Ziggy? Number one, there's not a lot of volatility, so you don't have a lot of premium in the calls or in the puts to try to do other adjustments. And what's the other issue? Well, because the high dividend and the low probability as well, they don't move that much. So if I entered a stock with a high dividend, that's already priced into the put. So sure, I could collect the 9% dividend. Let's say it was a 12% dividend, and over the next 7 months, I collect 9% dividend, but the stock's only moved 40 or 50 cents up or down. All I did was negate the risk and don't have any potential for further profit. Trading the radioactive techniques on a dividend stock is an approach, okay? But going with too high of the dividends, in that case, can loss. Ernie has an example that he wrote about. It's an article that you can find on Seeking Alpha as well, where he did a married put on NLY, Annaly Mortgage, which paid a 12% dividend. He held the stock for a year, could only manage to do 1 or 2 adjustments to reduce the risk. And at the end, the stock was down 10%. I think it was 8%, my apologies. The stock was down about 8% from where he bought in. He'd reduced the cost, he'd received the dividend, but essentially the position was at break even. So it's not a good idea for this approach on high dividend stocks. Just buying stocks outright with a high dividend, you're not going to see a lot of growth. You're just trying to make money on the dividend. But in the case of some event, poor performance in the sector that maybe your REIT is in, or your high dividend stock, or poor performance on the stock, then you might have a 9% guarantee coming in if you hold it for a year. But if the stock's down 8 or 9%, you broke even. Okay, you're not going to have a lot of opportunity for selling premium adjustments because of low volatility. All right, so that's the overview of our approach at Radioactive Trading, how we start a position. We use different adjustments, what we call income methods over time, to lower that risk and bulletproof the trade. Okay, but let's take a look at our comparisons. The reverse collar. This is taught by a couple different services out there, a couple different ideas. All of them are well-respected options traders and options educators. I believe Chuck Hughes is one of them who does this approach as well as others. I think Tom Sosnoff has talked about this at Tasty Trade 1 or 2 times, and I think there's a service out there, not related to them, that you can actually pay to see their picks for this reverse collar low-risk idea. In a reverse collar, you take the general concepts of a collar and reverse them. Now, a standard collar, again, talking about AEIS, if it was trading at 62.42 today, what I might do is buy the stock, and on March 2nd, for example, I might have sold an April 62.50 call for, let's say, $1. Okay, so that's a 62.50 right at the money, and I might have bought an April 60 put if it was available for maybe 40 cents or 50 cents. Maybe I have to go to the 55 or the 57.50. Okay, so I generate a small credit, and what I'm hoping, just like a covered call, is essentially a covered call, 1 month out or less, with an additional out-of-the-money put. It takes away from some of the profit, but to guarantee a low risk if you're wrong. So typically what I look for, I trade standard collars. What I look for in my portfolio is to maybe see a return of 2.5% or more if I'm assigned, without taking a risk of more than 4%. And of course, if I've got a potential for a return of 3%, I might go up to 4.5 or 5%. Okay, that's a standard collar. Same expiration, at the money call, out of the money put, looks like a bull put credit spread. But now, this reverse collar idea sort of changes those a little bit. So what we do in a reverse collar is I'm going to buy the stock as we would in a collar, a married put, or a covered call. and I'm going to buy a 1 or 2 month out of the money or at the money put. And then I'm going to sell a 4 or 5 month out of the money call for a higher premium. The two options transactions here, I want to be done at a credit to lower the total cost basis of the stock. Okay, so what would a structure have looked like on AEIS on March 2nd? Rather than doing the radioactive trade, I would have bought 100 shares, again, of AEIS at 62.42. I might have bought an April 60 put, which was priced at 160. I use the historical chain on power options to get these prices, and I'm using midpoints here, okay? So I'm not trying to give favor to bid or ask. And then I would probably sell a July out of the money 65 call at 380. So between the options transactions, I'm gaining $2.20 of net credit on the position, which means I'm lowering my cost basis to 60.22. Remember in the married put, we had a total cost of 69.77. We already talked about how that's not really the break-even. It's only the break-even at expiration if I do nothing. Now, the structure of this trade, the way that it comes out, again, we kind of showed you the profit and loss chart with that strange sketch, but the max risk on this trade is only $1.90 or 3.2%. Half of the maximum risk I have on the married put to the near-term expiration at April. Okay, here's the profit and loss chart of that AEIS reverse collar. What you can't see on this, of course, is that this sort of continues down here and may eventually get to a profit on the downside if the stock really gaps down about $35, $32 per share based on this particular structure. Other structures, you might have a little profit here on the downside. Here's your risk, and then it kind of curves off here as well. Okay, so what are we looking at here? This is to April expiration. 40 days or so out in time, 45 days or so from when we open the position on March 2nd. You're in the red zone here from about 55 to about 65. Okay? Why does this curve? Well, it's because the call is further out in time. You sold a 65 call where you have a capped gain, but that's at July expiration. In the short term, what is happening? Well, this option, your July option, is still retaining most of its time premium. Sort of like the reverse curve we see on a calendar spread here. But what do we have? Do we have a limited risk position? Yes, we do. Remember, we talked about the maximum risk if in the first month the stock's trading right at 60, falls down to 60 from where it is at 62.42, we're only risking $1.90 or 3.2%. It does offer a very low risk. But that's just for 45 days of trading. Okay, so the pros and cons. We see a lower risk just to the first expiration. So what happens if the stock is trading at 61 at April expiration? I can't really effectively roll that 65 call. Sure, it dropped, and I probably lost some intrinsic value, but remember my July put, which was 4 months out in time, has only lost a month of time decay. Okay, so we're at the 90-day mark. We haven't lost a lot of time premium. So managing it is going to be difficult. When I manage a call, I want the time value to be less than 1%. Okay, this probably isn't close to that. It's still retaining its time premium. Okay, so it kind of falls in that position there. You did lower the cost. I have a cost basis of $69.77 on the married put. You've got a cost of $60.22. And you may be able to have a profit to the downside if the stock really falls. Some of the cons of this position we already saw. The gains are capped because of the obligation of the short call, and to cancel the obligation of selling the call for further upside, you're going to have to roll it. And if you have to roll the call in the reverse collar in the first 20 to 30 days, you got no time value decay benefit or very little time value decay benefit in your favor. And if the stock stays in a range, a trading range, you're going to hit the maximum loss and then be forced to face another issue on the reverse collar. What's the other issue? Management. See, in the married put, if the stock went up to $65 or $66, I can now choose to sell a 67.5 call 1 month out or a 70 call to lower my risk. But in this reverse collar, you've already obligated yourself to a short call. So as the stock moves up, you're going to have to pay more to manage that call. You're not going to see time decay in your favor. You're going to be paying more, either intrinsic or as the stock goes to 65, it's now at the money, it's going to have the highest time value of all options around it. Okay? So we reversed the three core principles. Our short call that we got a good premium for, though, is going to decay more slowly. We've already entered into this idea that we've sold a call already. Management becomes a little bit more difficult, and it becomes harder to adjust if we want further upside. Now, if the stock stays above 60 at April, what happens? Your call expires your put expires worthless, excuse me. Might not be able to manage the call that well, so what happens? You got to buy another put, a May, a June, or a July. Now what are you doing? You're adding back into the cost basis for additional protection to stay in the trade to hopefully get more time decay. But this means that probably by buying the April option, then if you bought a May option and then a June option, you probably paid more total than that risk I had on the position to begin with. Okay, you're adding to your cost basis. You're increasing your annualized cost by buying more puts because the call didn't decay enough in your favor. Okay, so just thinking about those three core principles. Are you forced into a proper position sizing? Yes, we had to buy the stock. We had to put in the capital to do that. We lowered our cost basis by the call, and we have a very controlled risk. I like that about this strategy. So we've got proper position sizing and very good limiting risk. As far as the option principles of the ATM bell curve, did we solve those? No. We went opposite, didn't we? You sold an out-of-the-money call, so you did collect a lot of premium, but you had to go further out in time to do that. So it's not matching the ATM bell curve of trying to get the best premium and time value in your favor in selling. And you're typically buying an at-the-money put, where we usually want to be buying in or out of the money. So the ATM bell curve is not satisfied. What about the time decay? Nope, we reversed those too. You sold a far-out call, which is likely going to make management more difficult because you're not going to get the time value decay in the favor. You didn't put time on your side. And you bought a near-term put, which means that you're going to have a higher annualized cost if you keep having to buy that put over and over again. Now, sure, you collected a credit of $380 in this case to cover the $160 cost of the put. But if you have to buy the put 1 or 2 months again at a price of $150 or $160, you've now negated the premium entirely. Now, if it goes to 65, you get just the intrinsic gain as well. But it capped the gain. You're increasing your annualized cost for buying the insurance, and you're lowering your annualized return for selling the far-out call. We don't satisfy two of the three core principles of trading. All right. Now, our poor man's married put, the in-the-money strangle. I'm not going to buy the stock at 62.42. I'm going to buy an in-the-money call far out in time with a delta as close to 1 as I can get. We're going to mimic stock ownership by purchasing that deep in the money call with a high delta. And we're still going to purchase the in the money put that's likely far out in time to protect both directions. Now, I'm actually going to be more fair in this comparison. I'm not going to use buying the in the money October call and using the October 65 put, because it wasn't a fair comparison, because the October calls that were in the money that had a delta close to 0 had no open interest and had not traded at all. And you're looking at almost a 6-point bid-ask spread, so there's no guarantee you could get any price. So our comparison is the July. On March 2nd, with AEIS at 62.42, we could go deep in the money and buy a July 45 call for $17.95 or likely higher. Okay, this had a delta of around 0.94. Why didn't I go to the 40, which had a delta of 0.98? Because there was an 8-point bid-ask spread at the time on March 2nd. When I looked at the history, there was no open interest. It had not traded. Okay, and believe it or not, the 35 had traded. Bid-ask spread was okay, but there was 2 contracts of open interest. So the 45, I think it had about 12 or 15 open interest, had traded recently within the past 5 days. okay? 17.95 was the midpoint. Again, the stock was at 62.42. So it's $17.42 in the money, so you're only looking at 53 cents of time value for this deep in the money call. And the July 65 put, which again was, $2.68 in the money, was only priced at $6, so less than the 735 for the October. All right, so there's our position. There's an in-the-money strangle. Delta here of 0.94. The delta of the 65 put was pretty close to what I had on the October. Okay, it was around 0.58, 0.60. Oh, sorry, 0.58, 0.60. All right, now, the total invested between these two is $23.95. So that's almost a third of the cost of what I paid for the married put at $69.77, isn't it? And not quite a third of the cost, but just, not as much as that for what you would have invested in the reverse collar. Now, because both these options are in the money, the 20 points in the money, that 20 points cover the range. So if the stock was at 50, your call's worth 5 points of intrinsic, your put's worth 15 points, so it'd be worth 20. And if it was at 60, it's the reverse. So the true risk is only $3.95. Okay, that's the worst case scenario for this July in the money strangle, the poor man's married put. But that represents 16.5% of your investment. And again, the lie of leverage. You might consider, and that's, okay, monetarily, one contract to one contract versus the married put, this is a lower monetary risk than the married put I got into, okay? But if you overtrade and think, okay, well, Mike put almost $7,000 in to buy 100 shares in one put, I could do 3 contracts of this in the money long strangle, you're now risking close to $1,200. Okay, still 16.5% of what you invested monetarily. You're risking a lot more. You could overtrade this very simply. You still have to be disciplined. All right. Here's the profit and loss chart for the position. Now remember, the stock when we got in was at 62.42. Okay. So here's the idea. You've got the 45 call. You've got the 65 put. The risk, worst case scenario, is $3.95 if the stock is trading between those strike prices at July expiration. Between, you get this little curve, okay? So you're not going to lose as much. The worst case scenario, of course, is right in the middle of the 2 strikes. Okay, we don't want it to be trading at 55. But again, what do we see here? We need a more significant movement before we start getting to break even at the halfway point, or even 5 days out in time, or 10 days out in time, okay? Why? Well, we did try to get a delta as close to 1 as possible that was realistic. Okay, so here are pros and the cons. Pros, naturally, why would I do this? It's a lower cost. Poor man's married put. You pay less in, but you run the risk of overtrading. With the 7,000 I put into the married put, you could do 3 contracts of your in-the-money strangle, but that means you'd be risking about $1,200, where I'm risking $477. So you'd have to apply discipline and your own proper position sizing. Another advantage of this that we saw, we can profit in both directions. There's a really bad gap down, an unexpected poor earnings between now and July expiration. The stock falls from 62 down to 48, or maybe below 45. Hey, you're going to have a profit to the downside. The reverse collar might have a very small profit. My married put would be at maximum loss. That's an advantage. I can structure. There's an income method I could use on the married put to profit in both ways. I've got 3 positions like that open with income method number 12 that are Fusion subscribers for my actual open married puts going into earnings for 3 positions this week and next week. Okay, the cons. Higher percentage at risk. You're only risking $3.95, but that is 16.5% of what you invested. Remember gambler's ruin, what we talk about. If I have a 5% loss on a position, okay, I only need about a 5.2% gain to get back to break even. If I have a 10% loss, I need an 11% gain to get back to break even. And if I have a 25% loss, I need a 33% gain to get back to break even. That's the slippery slope. So around a 16% loss, if you take that on this position because the stock doesn't move, or drops down and stays right around 55, sure, you could apply some management, might increase your risk to the upside or downside by selling a call or put against it, trying to create a double diagonal maybe to manage your in-the-money strangle or so forth. But that changes the dynamic of the trade. It would change your risk profile. It would change not leaving the upside open as well. So taking a full loss of 16.5%, you're probably going to need close to a 26 or 27% gain to get back to break even. That's the slippery slope. And this is not delta neutral. Okay, when you look at this position, some investors say, oh, it's delta neutral, of course, and once one takes over the other. This is not delta neutral. This is delta opposed. And you won't see a gain on one option outpacing the loss on the other until there's a significant movement one direction or the other. Okay? The other issues, well, it's the price. And I don't mean the cost. What I mean is the actual reality of getting that price at $17.95 that I showed in this example. And I did choose the one that had open interest when I looked at the historical chain. The deep in the money calls with this higher delta of closer to 1 are going to have a wide bid-ask spread. I should have said wide instead of high there. They're going to have a wide bid-ask spread. On March 2nd at the close, the July 45 call we looked at had a bid-ask spread of 1570 to 2020. And so I used the midpoint of 17.95, okay? But there was low open interest, but at least there was some, and there was no volume. So where's the issue? There's no guarantee that we could get 17.95. If I had placed that order to buy that July 45 call on March 2nd for 17.95, I probably immediately would have seen the bid-ask spread adjust at my broker on power options and in exchange to where the new bid was 17.95 and the ask was 20.20. Market maker is going to force me here as close as he can. So I adjust it again and say I want it at 19. Well, now I might see the bid go to 19 and the ask at 20.20. No guarantee I'm getting midpoint on this position. Okay, it makes it tougher when looking for those higher deltas of close to 1, even if there is some open interest. Okay, so that's some of the other issues that comes out with this trade. I ran an example a couple weeks ago during one of our Friday open discussion sessions, and the in-the-money options that the customer was looking at out for January were so deep in the money, the bid-ask spreads on a $40 stock were 6 points, and there was no open interest anywhere near where he was trading. He's going to get the ask price or maybe 10 or 15 cents below it. He's not going to get midpoint at that. Okay, but all right. Let's talk about the 3 core principles. Does the in-the-money long strangle force proper position sizing? No, it's a leverage trade, so you're not forced into an ideal size trade. But unlike the reverse collar, do we satisfy the ATM bell curve? Yeah, both options that you're buying are in the money. Okay, so you're paying a lower time value, only 53 cents for the call, and the July put only had about $2.20 or maybe $3 or so of time value in it. Okay, so for going far out in time, that's pretty good. With the high delta of 1, you had that lower of 53. Is time decay on your side? Yes. Both options were roughly about 5 months out in time, 6 months out in time from when we would have got into the trade. 4 or 5 months, my apologies. So both options are far enough out where we start to see that lower time decay in the first 30 to 40 to 50 days against us. And of course we can gain intrinsically. But remember, you're not delta neutral, you're delta opposed for that first maybe 4, 5, or 6% movement up or down before one option really starts to counter the loss on the other. All right, well that's great as far as the comparison goes, but what does the math look like? And since March 2nd, AEIS has moved up significantly, but what if the stocks remain the same or fell? Okay, I'm going to go over to power options right now, where I've incorporated these 3 trades into our portfolio, and we're going to take a look at those scenarios very quickly. Okay, so let's go ahead and change my screen here. My apologies, there we go. All right, so make sure that transfers over, and I'm going to highlight it for you. I know it might be hard to see here on your full screen, but I want to highlight it here. First is the married put on AEIS. The price, I'm sorry, I have the date of 315. That was meant to be 3.2. Apologies with entering. All right. So we've been 43 days, a little bit about 50 days into the trade since March 2nd. Okay, now, here's the correct prices, 62.42 and 7.35. Where's the stock today? Stock's at 74.79. Okay, so it's moved up $12.37 since March 2nd. We're looking at about a 20% gain. So we gain on the stock here. Did my put option go to zero? No, it's priced at 250 right now at the midpoint. So I gained 12 on the stock. We left the upside open. We had a properly structured trade. I do give back about 5 points, but with the stock up 19%, 19.8%, I could liquidate the married put right now for a 10.8% gain. Sell the stock at 74.79, sell the put at 250. Okay, we get roughly 77.20 back. Yeah, I'm sorry, 77.29, so we have a profit of 10.8%. Yes, we gave up some, but we still made over 50% of what the stock makes. The put's not an automatic loss when we purchase it. All right, the long collar that's shown, what happened there? Okay, well, we've got our July call, 65 that we sold for 380. We've got our near-term put. I had to use the May because we crossed April, but we used the near-term put at 160. So what's going on? Well, the 160 put's expiring worthless, it's only worth about 20 cents. The call has moved up to a price of $11.35. This is not in my favor. I sold it, so to buy it back, I've got to pay $7.55 more. And the stock gained $12.37. We own it. So what ends up happening? Well, I still have a profit, but it's only 5.8% because of the capped gain. Now, 5.8% gain, 50 days of trading, not too shabby. I like that. But again, almost double that with a married put because I left the upside open. And how about the in-the-money strangle? Well, of course, it made a profit, $12.15 on the call, pretty much close because we had a delta of 1. Our stocks gained $12.37 for the reverse collar and the married put. We gained $12.15 there, and we lose almost the same amount on the July put that we lost in the October, about $483 to $485. So the gain's about $7.30. Right? Profit $12.15, lose $483. We're going to call it $7.30. Double the reverse collar, the $347 to $7.30, and about equal to the married put. No adjustments, just what happened with about a 20% gain. Okay, so is one necessarily significant to the other? Is one far more superior? Well, to me, the married put's superior. We have a higher monetary gain. I know you're going to argue that no, in this case, the long strangle is more beneficial because you've got a equal monetary gain, but percentage-wise, it's triple it. Okay, you can argue that, but let's talk about other scenarios. So this is an extreme example, 20% up. We make about 11% on the married put. We make about 5.8% on the reverse collar. And $7.30 off of our investment of 23, what is that? It's a little bit over 30%, so about triple, percentage-wise, on the ITM long strangle. I want to go to the profit and loss chart. Here we are 50 days in. Okay, but let's take another couple days. Let's say in the next, couple days. Remember our price was 62.42. So on the married put, let's say we only had a 5% gain. Next week, it drops back down. And so the stock would have moved up about 3 points. Let's call it 65.50 for a 5% gain. More realistic. And we see the 65.50 gain around May 3rd. Okay, it's about 2 months in, 60 days in, 5% increase. Okay, so what would we have? We have a gain of about 308 on the stock, and we're only going to give up about 189 on the put using the Black-Scholes pricing model. So with a 5% increase, more realistic 60-day period, I've got a gain of $119 on the married put. And what would happen if the stock falls 10%? So again, let's say it falls 6 points, and let's call that 56.25. Okay? So what happens if we drop 10% on May 3rd, around the corner? Well, again, we're going to lose 617 on the stock, 10%, and our put's going to gain about half of that back. We'd expect a gain of about 330 or so with the stock falling 600. All right, so we have a loss. And we have a loss of $285 on the position. Okay, so why am I going through this? Let's take those same scenarios. What happens if the stock was at 65.50? Okay, for the other two trades on May 3rd. And what would happen if the stock was at 56.25? What could we expect? All right, let's just take a quick look. Let's go back. Let's take our reverse collar. Let's go to the profit and loss chart, put in our same numbers. Okay, so here's that position. Now, 60 or so days in, on May 3rd, our stock's trading at 65.50. We're up about 5%. No change. We're not assuming any change in volatility for these positions. Let's keep it average. So here, stock right around this area. Now, of course, this would have been April, I know, but we're simulating the April 60 put we would have bought with the May 60 put, okay? And so 60 days in, well, we've got our gain of 308 on the stock. Our call declined in value, got some time decay in our favor, but now we're getting closer to the ATM bell curve. So as our intrinsic value, our time value decayed, the at-the-money bell curve phenomenon took place. We only lose $1, and of course we're losing more than $1 on that as well. On the put, it's going to 0. Okay, so here we have a gain of $74 in the case of a normal movement, and of course we know if the stock had stayed the same price, we'd have probably a loss at that point around 60 or 62.5. And what happens if the stock falls 10%? Same date on 56.25. We're at a loss of $92. Okay, so what do we see here? I'm sorry, yeah, you're still at a loss of $92, which was less than the married put. Remember, my married put was a 285 loss, okay? So what are we seeing here? You get a capped gain on the position. So we had about half the gain with a large movement in the stock. We had a lower gain if the stock was in the general trading area, 4, 5, 6% gain, as opposed to what we would have seen in the married put position. And in order to start getting a counter to where we lose less than the married put, we're talking about a 10% decline, so we're getting closer to this range. So here's an advantage. Here, plus or minus 3 or 4%, reverse collar is not an advantage. And remember, as I get close to expiration, I now got to consider what to do with this call. Do I buy it back and roll it? Do I adjust the position? Do I buy another put which adds to this cost basis and puts me in the wrong direction? And again, we saw the 20% increase because of the capped gain and the time value still remaining in the call. We're giving up more to the upside. Max risk is only 190, but realistic trading. Stock moves up a few percentage or down a few percentage. We have more of a gain on a married put here. We have about an equal loss in this range, and then of course you have a less loss here. So 2 out of the 3 times the married put outperforms the reverse collar. And in the case of a large gain, we know what happens because you already obligated yourself to a capped position, and you're going to have to put a lot more money in the position to manage it. Okay, so 5% increase, $119 gain on the married put, a $74 gain on the reverse collar. Stock falls 10%, sure. I've got a 285 loss, close to about 5% of what I had invested in the position, maybe a little less, about 4.2, and the reverse collar would have only been a loss of 92. Of course, right now where the stock's at, we're at a gain about 11% on the married put and 5.8% on the reverse collar. And to manage it, we've got to put a lot more money in the position or just try to liquidate out of it as well. All right, and number 2. Poor man's married put. Equal profit and loss chart, but a higher percentage, close to the 30% range to the married put. Monetarily, it's close. Percentage-wise, it's gangbusters because you use leverage. But what about the other scenarios? Okay, so here in the portfolio power options, let's go to the profit loss chart one last time. What were my prices again on May 3rd? 65.50. Gain of about 5% from where I purchased the position. Would have had a $119 gain on the married put. RadioActive Trade. $74 gain on the reverse collar, May 3rd. There we go. Equal gain to the reverse collar. Why isn't it higher? Because it's still delta opposed. It's starting to get to that difference here at 65 where it's taking over, but you needed much more of a movement. Okay, and that's sort of the disadvantage of this. Even though your call option had a delta close to 1, you need a bigger movement before you start seeing the same benefit that you get with the married put to the upside. And we saw that. Okay, 20% movement, we're about even monetarily on this in the money strangle. But 5% movement, you're still lagging behind, so it's equal to the reverse collar. Now, what happens, of course, if the stock falls to 56.25 with our July 65 put and our July 45 call? You're at a loss of 171. A 10% drop in price is not enough to have the put start countering your call that had a delta closer to 1, because your put delta was probably only around 0.6. So you're going to need a 20% drop in the stock before this starts taking over. Okay, so again, is the monetary loss on the in-the-money strangle lower than the married put with a 10% decline? Yes, remember I was at 285. I was at 285 of a 69.77 investment, okay, which would have come down to only about 4%, maybe 4.2% of what I invested in the position with a 10% decrease in price. You're looking at a $171 loss on the in-the-money strangle, but that's on an investment of $23.95. So again, the lie of leverage. This is closer to a 9%, not 8.5, 9% gain, about half, right? 171 is a little bit less than half of that, so you're probably looking about an 8.5, 8.3% gain. Loss, okay? So double the percentage loss. Remember what we talked about. If you've got a 10% loss, you liquidate it now because it wasn't going in your direction, you need an 11.1% gain to get back to break even. If I liquidated for the 4.2% loss, took this money and reinvested it, I probably need a 4.4, 4.5% gain on what I invested back in to get back to break even. Okay, because we're falling in that slippery slope, the lie of leverage as well. Okay, so what's your strategy? What's your approach to your portfolio? Is the poor man's married put more beneficial to you because of the lower cost? Well, you run the risk of overtrading, and you run the risk of falling into the lie of leverage. If our stock dropped 20%, you might be looking at close to, again, a 15 or 16% loss in your position. I'm only losing 6%, 6.5% on the position with a married put. The reverse collar, you might start to be getting in a profit. I'm sorry, 20% drop, you might start getting into a profit. But what kind of stocks do you pick on a regular basis? All right. The advantage of the in-the-money long strangle is if the stock really takes off or really falls in price. The lie of leverage is going to come back to haunt you. What kind of stocks do you pick on a general basis? Are you picking stocks that fall 15 to 20% or move up 15 to 20% on a regular basis? Or are you picking stocks at sort of middle about plus or minus 3 or 4%, where we've kind of already showed that percentage-wise, the married put performs better. And on the 5% gain, we get more monetary gain as opposed to the other two. So really, your bang for the buck is in here. And that's what stocks we're most picking. And in that case, if you're picking stocks that over a 20, 30, 40, 50, 60-day period are only plus or minus 5%, I think the married put RadioActive Trade is superior to these two approaches. If you constantly pick stocks that have roughly a 20% gain with one or two that have a 20% loss because you're going more volatile, well, you're probably doing a different strategy altogether. If you can do that consistently, you're probably just buying calls and occasionally buying a put for the downside. You're not really doing this other trade, even with a delta of close to 1. And remember, there's no guarantee that you're going to get that position, get that midpoint price. Keep in mind what the losses would have been on this trade and how less the gains would have been, let's take a look. Instead of getting at that midpoint at 17.95, what if the market maker forced me closer to 19.20? Okay, well, now I've got more cost in. I've got a risk of 20.8% on the in-the-money long strangle because the market maker wouldn't let me get midpoint. And again, at 65.50 and May 3rd, instead of a gain of $74 after a 5% movement, you're at a loss of 56. And reverse, of course, we have that 10% drop down to 56.25 on the 3rd. You're looking at a loss of 295 now, equal to what I had on the married put, more than what I had on the married put, but percentage-wise, you're at about 12-14%. Okay, so that's the risk of the in-the-money long strangle. You assume that with a delta closer to 1, you're going to be able to get a price where you're only paying a time value of 53 cents. Those options are thinly traded, very thinly traded. Not a lot of interest. You're fighting the market maker as well. Okay, so you've got to decide what's best for you. But in my opinion, the radioactive trade solves the problems better. It satisfies the 3 core principles. The only one of the 3 that we looked at, including the long call. Okay, so of the 4 trades we looked at, this is the only one that satisfies the 3 core principles. And from the start, like the in-the-money strangle, I didn't cap my gain to begin with. Okay, I bought in the money. I didn't sell a call right away to cap my gain. I'm going to wait for a movement, and then I might even find an income method that we use at Radioactive Trading that's better than just selling the 75 call now on AEIS. There's other adjustments. There's 12 different income methods I could use. That reverse collar forces you to focus on just managing the long put, managing the short call, which is very far out in time and not decaying rapidly in your favor. But you've already sort of forced yourself that you have to manage one of the other one in order to get more profits. You don't have a lot of opportunity to sell later for a better price. You got to buy back first and then sell, and it's probably adding to your cost basis to get higher gain. Okay, so you're increasing the risk, the chance for loss on those adjustments. So I'm not a fan, really, of the reverse collar. I appreciate greatly that it has a lower maximum risk. I love that. But if I'm in a position, again, where I'm looking at a profit and loss chart of this reverse collar position, where I see the profit is, I can have profit to the upside and potential profit to the downside, but if I'm expecting a movement where the stock might swing up to here or could swing down to here, to tell you the truth, I'm being careful with my discipline, but I'm buying a straddle or strangle position to take advantage of both sides without the capped gain and keeping my monetary risk down and my number of contracts in the proper position size. This does force a proper position size, so principle number 1 is satisfied, but it goes reverse of the ATM bell curve where I want to be selling at the money and buying in or out, and the time decay where I want to be buying further out in time and selling closer in for a better annualized return. Okay, that's why I'm not necessarily a fan of the overall approach of this particular position, but I gotta love the limited risk, and I do love that it forces an ideal size trade. And then, of course, the in-the-money strangle there, what does this give us? Doesn't force the ideal size trade, does leave the upside open, does take advantage of the at-the-money bell curve, and it does take advantage of the time decay factor. But again, you run the risk of overtrading, and we've already seen realistically in the market, real-world trading, how you're probably not going to get the best price for that deep in the money call that has the option closest to 1, okay? And you're not necessarily going to see a profit if the stock moves a reasonable amount. If it moves up 5% or down 5%, the loss you have on the married put and the gain you'd have on the married put is going to be monetarily higher. And if you end up paying too much because you can't get the midpoint of your deep in the money call, guess what? You might still be at a loss even if the stock moves up 5% or down 10% on the price as well. I just don't think this idea of forcing it to be as close to 1 as possible and far out in time is a realistic trade, because getting that price with only 20 or 50 cents time premium on most securities, you're going to see a wide bid-ask spread, and because it's so thinly traded, I have a feeling you're going to get closer to the ask price and not have that true benefit you wanted of the deep in the money call. All right. So again, this is why I feel the radioactive trading technique is superior. And you're welcome to argue with that. You're welcome to have your own decision. You have to decide what you trade in your account. This is what I trade with 50 to 60% of my personal capital in my account. The radioactive trading techniques as described by the blueprint. I've been trading this way for about 7 to 8 years, since 2007, almost 10 years now, really. It's about 2008, end of 2007, beginning of 2008. But what does the blueprint do? Well, it teaches you the proper setup. There is such a thing as going too deep in the money and taking too little risk with the married put setup. There's a thing as taking too much risk by doing the married put setup incorrectly. The structure teaches you how to set it up to follow the 3 core principles correctly, and then the proper use of the 12 different adjustments that we use to lower the initial at risk, generate income to lower the cost basis to where we can have a point where we have no risk on the trade, still several months of insurance out in time, and still potentially have an unlimited upside profit potential. Okay? That's what we teach. It's a full trading method. 12 different ways to adjust the position. You don't really need all 12. Okay? You might not use some of them, but again, unlike the reverse collar, we're already forced in the idea that you have 2 legs you have to manage before you can think about doing anything else. This here gives you opportunities where if my stock moved up 5%, I could generate income by just selling a call. There's 2 riskless spread trades done in this context that I could do to take advantage of a spread trade, generate income, but still leave my upside open or outperform just selling a covered call. And remember what we saw. My put didn't go to 0 even when the stock moved up 20%. I can manipulate that time value that remains on the put as well to lower my risk and lower the cost basis on the position. And what else comes with the blueprint? Well, you get the full trading technique that I feel is superior to these other limited risk ideas. Okay? You can check out our special bonus offers right now if you go to radioactivetrading.com/iridium. Okay? What are the special bonus offers? Well, we'll send you something called the Quick Action Guide to help you get started more quickly. Okay? It's usually a $50 value. One of the 6 Mastery Series CDs that we have, or Master Series videos that we offer, the Foundations of Radioactive Trading is one of the 6. We'll send you that for free as well if you pick up the blueprint today as a special bonus. It usually runs about $89 to buy individually. We'll send it to you included with your blueprint if you pick that up today. The Fusion service I talked about, where you can see my trades, you can see Ernie Zareno, the president of Power Option, you can see his trades as well, following the radioactive trading techniques plus lessons and other tools to implement radioactive trading. You'll get your first month of Fusion for only $10. It's usually about a $69 value, so you're getting a $59, I should say there, benefit of that bonus. And of course, you'll also receive a free month of Power Options. We showed some of those tools today, usually $60 per month, but you'll get a free month to start testing the tools, tracking your positions in the portfolio, running your what-if scenarios as well. And of course, anyone who purchases the blueprint gets a free hour-long session with either myself or Ernie to help you get started and to help you get going. But remember, Fusion subscribers and Power Option subscribers can also schedule a coaching session at any time, another benefit of subscribership as well. In addition to all of that, the bonuses that almost add up to the cost of the blueprint, pretty much do add up to the cost of the blueprint as well, we offer a money-back guarantee. If you're not satisfied with the material once you receive your blueprint and you start going through it, you send it back to us, we'll refund your purchase cost, no questions asked. Okay, so you can get advantage of the 5 special bonuses. Go to radioactivetrading.com/iridium. I sent you that link there. Pick up the blueprint. In my opinion, the best of the ways to properly limit risk, satisfy the 3 core principles of any trade. Okay, not just what we're talking about limited risk trades, those 3 core principles, you want to start focusing. If you take nothing else out of today's presentation, I want you to consider that you should apply those 3 core principles to what you're doing with your spread trades, what you're doing with your covered call positions and your naked puts, and what you're doing with your diagonal spreads. Okay? Make sure that you're properly structuring it so you're properly position size and you're not over trading. Make sure you're taking advantage properly of the time decay value, that you're buying options that are a reasonable amount out in time and you're selling nearer term. to benefit for you. And of course, always remember to make sure that you're getting as much premium as possible. I had a discussion last week with a customer who, it was an interesting approach. He's doing very, very deep out-of-the-money credit spreads, 7 days, 5 days out in time, with a probability above 90 and generating 2, 3, 4 cents of credit for the credit spreads, trading 40 to 50 contracts of each. And I looked at it, I looked at his commission costs, and I just thought to myself, why? Why wouldn't you just go a little bit more out of the money, take a 70 or 80% probability and make 20 cents and only do 10 contracts? This seems unnecessary, but to each their own. But again, you want to make sure that you're following the 3 core principles for all forms of investing as well. All right. Well, I'm sorry I went over time, folks, but again, this is my thoughts on this as well. This is why I think the radioactive approach is superior to the other 3 limited risk approaches. And we have older webinars that also talk about it against the long call, which I shared with you today. Trying to do a calendar put spread or a naked put to get in the stock first and then add the put option as well. We covered that in other strategies, and the married put radioactive trade always comes out on top with just the basic structure, not even including any income methods or adjustments you could do on one and not the other. But remember, the adjustments I could do right now on that in-the-money long strangle, the poor man's married put, and my radioactive trade, I couldn't do on the reverse collar because I got to adjust the call first before doing another call or anything else, or figure out what to do with that put that's going to zero if I want to keep insurance on that position to continue the trade. Okay, so either way, I'm adding cost into it on the reverse collar to get more upside. But again, if you have any questions, not if you think you have, if you have any questions about the material presented, radioactive trading techniques or the blueprint, just send me an email to support@radioactivetrading.com. Of course, remember, those of you living inside the U.S., you can call us toll-free during market hours at 877-992-7971, or you can reach us at any time if you live outside the U.S. at 302-992-7971 as well.